Unveiling the ultimate law of wealth creation. The concept of the ultimate law of wealth creation is subjective and can vary depending on individual perspectives and economic theories. However, one commonly discussed principle in wealth creation is the idea of compounding. Compounding refers to the process whereby wealth grows exponentially over time through the reinvestment of earnings. This principle is often associated with compound interest, where interest is earned on both the initial principal and the accumulated interest from previous periods. The ultimate law of wealth creation could therefore be seen as the consistent application of disciplined saving and investing over time, allowing for the compounding effect to work its magic. This involves saving and investing early is a fundamental principle in wealth creation and financial planning. There are several reasons why starting early is advantageous. Compound interest. As mentioned earlier, compound interest is a powerful force in wealth accumulation. By starting to save and invest early, you give your money more time to grow through compounding. The longer your money compounds, the greater its potential to grow exponentially. Long-term perspective. Starting early allows you to take a long-term perspective on your investments. You have more time to weather market fluctuations and benefit from the long-term growth potential of various investment vehicles, such as stocks, bonds, and real estate. Lower risk. Starting early also allows you to take on more risk in your investment portfolio. Riskier assets, such as stocks, historically offer higher returns over the long term compared to less risky assets like cash or bonds. With a longer time horizon, you can afford to ride out market volatility and take advantage of higher potential returns. Developing financial discipline. Starting to save and invest early instills financial discipline and good money habits. It teaches the importance of budgeting, setting financial goals, and regularly contributing to savings or investment accounts. Retirement planning. Early saving and investing are crucial for retirement planning. By starting early, you can take advantage of tax-advantaged retirement accounts like 401(k)s or IRAs, which offer benefits such as tax-deferred or tax-free growth, employer matching contributions, and potential tax deductions. Flexibility and options. Starting early provides you with more flexibility and options in the future. It allows you to accumulate wealth and build a financial cushion that can help you weather unexpected expenses, pursue opportunities, or achieve financial goals such as buying a home, starting a business, or traveling. Overall, saving and investing early is a key strategy for building wealth and achieving financial security over the long term. Whether you're just starting your career or already established in your profession, making a commitment to start saving and investing as early as possible can significantly impact your financial well-being in the future. Consistent contributions are essential for achieving financial goals and building wealth over time. Here are several reasons why consistent contributions are crucial. Regular growth. Consistent contributions ensure a steady flow of funds into your investment accounts or savings accounts. This regular influx of funds allows your investments to grow steadily over time, taking advantage of compound interest and the power of compounding. Dollar cost averaging. Consistent contributions enable you to practice dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market fluctuations. This strategy helps smooth out the impact of market volatility over time, potentially reducing the risk of investing a large sum of money all at once during periods of market highs. Discipline and habit formation. Making consistent contributions requires discipline and helps form good financial habits. By committing to regular contributions, you develop a routine of saving and investing that becomes ingrained in your financial behavior. Achieving financial goals. Consistent contributions are essential for reaching specific financial goals, whether it's saving for retirement, buying a home, funding education, or building an emergency fund. By consistently setting aside money towards these goals, you make steady progress and increase the likelihood of achieving them. Maximizing returns. Consistent contributions allow you to take advantage of the long-term growth potential of investments. By regularly investing over time, you benefit from compounding returns, which can significantly increase your overall investment returns compared to irregular or sporadic contributions. Building wealth. Over time, consistent contributions, coupled with the power of compounding, can lead to substantial wealth accumulation. Whether you're investing in the stock market, real estate, retirement accounts, or other assets, consistent contributions play a crucial role in building wealth and achieving financial independence. Adaptability and flexibility. Consistent contributions also offer flexibility in adapting to changing financial circumstances. You can adjust the amount of your contributions based on changes in income, expenses, or investment opportunities while still maintaining a regular saving and investing habit. Overall, consistent contributions are a key component of successful financial planning and wealth-building strategies. By making regular contributions a priority, you can work towards achieving your financial goals and securing your financial future. Reinvestment of earnings is a crucial strategy for maximizing wealth accumulation and achieving long-term financial goals. When you reinvest your earnings, you're putting the money you've earned from investments back into the same investment vehicles rather than cashing out or spending the profits. Here are several reasons why reinvestment of earnings is important. Leveraging the power of compounding. Reinvesting earnings allows you to take advantage of the power of compounding. By reinvesting dividends, interest, or capital gains, you can generate additional returns on your original investment, which then compounds over time. This compounding effect can significantly enhance your overall investment returns, especially when compounded over many years. Accelerating growth. Reinvesting earnings can accelerate the growth of your investment portfolio. Instead of simply relying on your initial investment amount, reinvesting earnings allows you to continuously add to your investment principal, leading to faster accumulation of wealth. Automatic wealth building. Reinvestment of earnings creates a self-perpetuating cycle of wealth building. As your investments generate earnings, those earnings are automatically reinvested, leading to further growth of your investment portfolio without requiring additional capital from you. Dollar cost averaging. Reinvestment of earnings also enables you to practice dollar cost averaging, similar to consistent contributions. By reinvesting earnings at regular intervals, regardless of market fluctuations, you can mitigate the impact of market volatility and potentially buy more shares when prices are lower and fewer shares when prices are higher. Compounding returns in tax-advantaged accounts. Reinvesting earnings within tax-advantaged accounts such as IRAs, individual retirement accounts, or 401(k)s, employer-sponsored retirement plans, can have additional tax benefits. In these accounts, dividends, interest, and capital gains can grow tax-deferred or even tax-free, allowing for more efficient compounding of returns. Long-term wealth accumulation. Reinvestment of earnings is particularly beneficial for long-term wealth accumulation goals, such as retirement savings or building a nest egg. By consistently reinvesting earnings over many years, you can harness the full potential of compounding and significantly increase your investment portfolio's value over time. Overall, reinvestment of earnings is a powerful wealth-building strategy that can help you achieve your financial objectives, whether it's generating passive income, saving for retirement, or building long-term wealth. By reinvesting your investment earnings rather than spending them, you can maximize the growth potential of your investments and work towards achieving financial independence. Diversification is a fundamental principle in investment strategy that involves spreading your investments across different asset classes, industries, sectors, geographic regions, and types of securities to reduce risk. Here are several reasons why diversification is important. Risk reduction. Diversification helps reduce the overall risk in your investment portfolio. By spreading your investments across various assets, you can potentially minimize the impact of negative events that may affect a particular asset class or sector. For example, if one industry experiences a downturn, investments in other industries or asset classes may still perform well, mitigating losses. Smoothing volatility. Different types of assets tend to have different risk-return profiles and react differently to market conditions. By diversifying your portfolio, you can smooth out the volatility of your overall investment returns. When one asset class experiences fluctuations, other assets may provide stability or positive returns, helping to balance out the overall performance of your portfolio. Maximizing returns. Diversification can also help maximize returns by capturing opportunities across various market segments. While some assets may underperform in certain market conditions, others may outperform, potentially offsetting losses and contributing to overall portfolio growth. Preserving capital. Diversification is essential for preserving capital, especially during periods of market turbulence or economic uncertainty. By avoiding overconcentration in any single investment or asset class, you reduce the risk of significant losses that could jeopardize your capital. Stability and consistency. A diversified portfolio can provide greater stability and consistency in investment returns over the long term. While individual assets may experience fluctuations in value, A well-diversified portfolio is less susceptible to extreme swings and can help smooth out the overall trajectory of investment performance. Liquidity and accessibility. Diversification also allows for liquidity and accessibility in your investment portfolio. By holding a variety of assets with different liquidity profiles, you can access funds when needed without having to sell off all your investments at once, potentially incurring losses. Tailoring to risk tolerance and goals. Diversification enables you to tailor your investment portfolio to your risk tolerance and financial goals. By selecting a mix of assets that align with your risk tolerance and investment objectives, you can build a diversified portfolio that reflects your unique circumstances and preferences. Overall, diversification is a key strategy for managing risk, preserving capital, and maximizing returns in investment portfolios. By spreading your investments across a range of assets, you can create a well-balanced portfolio that enhances long-term wealth accumulation while minimizing downside risk. Patience and discipline are essential virtues when it comes to achieving financial success and building wealth. Here's why they are crucial. Long-term perspective. Patience is key when it comes to investing. Wealth accumulation and achieving financial goals typically take time, often spanning decades. By maintaining a long-term perspective, investors can ride out short-term market fluctuations and capitalize on the power of compounding over time. Avoiding impulsive decisions. Discipline helps investors avoid making impulsive decisions driven by emotions such as fear or greed. Emotional decision-making can lead to buying high and selling low, which can erode wealth over time. With discipline, investors can stick to their investment strategy and avoid making reactionary moves based on short-term market movements. Consistent saving and investing. Patience and discipline are necessary for maintaining consistent saving and investing habits. By adhering to a savings plan and consistently investing a portion of income, individuals can steadily build wealth over time, even during periods of market volatility or economic uncertainty. Resisting market timing. Patience and discipline discourage market timing, which involves trying to predict short-term market movements to buy or sell investments. Research has shown that market timing is notoriously difficult and often leads to underperformance. Instead, disciplined investors focus on their long-term investment goals and adhere to their investment strategy regardless of short-term market fluctuations. Sticking to financial goals. Patience and discipline help individuals stay focused on their financial goals, whether it's saving for retirement, buying a home, or funding education. By setting clear financial objectives and sticking to a plan to achieve them, individuals can make progress towards their goals over time. Avoiding behavioral biases. Patience and discipline also help investors avoid common behavioral biases that can negatively impact investment decisions, such as overconfidence, loss aversion, and recency bias. By maintaining a disciplined approach to investing and avoiding emotional reactions to market events, investors can make more rational and objective decisions. Riding out market volatility. Patience is particularly important during periods of market volatility. By staying disciplined and not succumbing to panic selling during market downturns, investors can avoid locking in losses and potentially benefit from market recoveries over the long term. In summary, patience and discipline are essential qualities for successful wealth accumulation and financial planning. By maintaining a long-term perspective, adhering to a consistent investment strategy, and staying focused on financial goals, individuals can increase their chances of achieving financial success over time. While compounding is a powerful force in wealth creation, it's important to note that other factors such as economic conditions, market fluctuations, and individual financial goals also play significant roles in the process. Additionally, ethical considerations and social responsibility should also be taken into account in any discussion of wealth creation.